Good day, all. Ira Epstein of Linn and Associates with your SPDR ETF video. This is your wrap-up for Tuesday, the 3rd of March, 2020, and we're right now at 5 p.m. Central Time. Interesting day. I woke up bright and early. I knew the Fed was taking part with U.S. Treasury Secretary Mnuchin in the G7 meeting. Now, we were all led up to believe that the Fed was going to cut their interest rate by 50 basis points. Lo and behold, the meeting takes place. It's a cheerleader meeting. All the governments are agreeing to do what they have to do. We'd already seen the Reserve Bank of Australia the night before cut its interest rate. Word was that the European Central Bank is getting ready to cut another 10 basis points, but nothing happens. So the market takes the news, starts trading one way. About 2 hours later, 2.5, whatever, the Fed comes out with a surprise announcement, but it's really not a surprise because the Fed watch page was almost at 100% probability Sunday night they would do something. And lo and behold, first time they've done it this way without a meeting since 2008, I think it is, they announce a 50 basis point cut. With that, the markets start going into free falls. And you got down in the Dow and other markets, again, we're like getting the 4-digit breaks in these markets, and you finish sharply lower. Now, you got to remember, you're up 5% one day, record amount in the Dow. You're down 3.5% or whatever the next day. It is a rough market to trade. The problem is when you get markets that are in a corrective mode like we're at, and correction from technicians is often called that from the high you've dropped and you're 10% lower than that high. That's a corrective mode. And with it comes a lot of volatility. Yes, you can go all the way into a bear mode at 20%. That's not where we're at. You're in this correction mode, which is wildness. So let's take a look and see what we've got. If we look at the technology sector, there's a vertical price drop. You've now had a 2-day bounce. I know you'll say it was down today, and it was down 3.8%. Yesterday, this index was up 5.78. I mean, these are not normal moves, okay? Normally you're talking you're up 1-2%, and that's about it, or down that amount. This is pretty wild as to what's going on. And all this market did is it filled a gap left 2 days ago. You still have this gap left here. I'm not saying it can't be filled, but right now, what's the pattern? Well, if we look at the pattern, you've had a pattern without today of lower highs and lower lows. The market failed against this 94.71. Another trick of the trade is you're always looking to see where this high is to this low on a big move. So let's assume we went from about 103 down to 84. The difference is 19 points or 9.5, right? That'd give you there. Add that to this low. You get to about 93.5. 50% correction. You learn to do that in your head. That's often about all a bear market goes. I'm not saying it can't go higher, but you're in that ballpark range. And the market started slipping back on you. Now, where's the market fighting? I think it's very evident it's in the 100-day range. We hit that 200 and we bounced away. Not all markets will pay attention to the 200. That's myth. You look to see which ones seem to be working. That seems to be working. So I call this market still very much in a downtrend. When I look at Bollinger Bands, you move to the right-hand side, which is typical. 95% of the time, the market will trade within these black bands. So I have a market that moved from a vertical decline back into the band, still very much in a downtrend. Momentum is still very much what? Oversold, but certainly not pointing upward. When we come to the industrial sector, this is what I mean when a market doesn't always pay attention to that 200-day average. It tried. When we come here, you can see the first challenge and even the next day. It was too much for the market. You're in a downtrend. You don't know that until after the fact. The momentum's pointing down and you just start accelerating on this. There's certainly no reason to be long, but I am looking for the market to move to the right-hand side of the Bollinger Band, and that's about all you did. Always, again, take your numbers and see what the number in your head is, that 50% number. When we come to the energy sector, unlike the others, this is not in terms of a technician talk. You've got a higher high and lower low. That doesn't mean the market hasn't stayed under this 18-day average and the bias hasn't been down literally this whole year. You tell me that that hasn't been the case. You had 2 days of the year so far where you're over the 18-day average. Everything else is under. But I am concerned now because you forced OPEC's hand. They have to do something here to get production off the market. They're talking this week of getting somewhere between, let's say, 600,000 barrels a day to 1 million barrels a day off the market. That's great unless Libya comes back on. And if they do, their move doesn't do much. That's the dilemma they're facing. So will they cut? Don't know, but do you want to walk into that meeting with a position? I'll let you do that because they're meeting right now. In QQQ, we had come down. The market had paused at the 100-day average and the lower Bollinger Band. Then it dropped again, and it did its job. It held the 200-day. Now the key is to move back to the right-hand side of the band, which it did the day before. So we had a low of 198.17 to up here around the 237 level. Let's call that 37 points. Just off the top of our head, add 18 to 198. This is how I do it. So 208, 218, right in there is what I'm looking. You tell me you had a 50% correction and the market's having a problem. So teach yourself how to do this. It's not that difficult. And I'm not a math wizard, I promise you. Now, what do? Well, the Fed's done its thing. It's not going to shoot that bullet again. It come the meeting, they're not going to lower interest rates one more time right now. They need those bullets. So I don't know what they did. I think the timing could have been better, but who am I to criticize the Fed? These guys are all smarter than I am. But that's where you're at. In the emerging market ETF, all you're doing is getting a bounce. The 200-day did not work here. It just slid away from it. So you recognize that. You had a bearish crossover where the 18 got under the 100, and I said yesterday, I'm going to keep repeating it, you're about to get another bearish crossover in this market. And that's not typically a good sign. Gold is trying to make a stand at what I call the line in the sand. You see that 18-day average? It's an important number in gold. It's important in most markets. It's where trends come from in the end of the day. Now, the problem here is you've got lower highs, lower lows, which is bearish. Now momentum's turning up, friendly, and bias is up. You got a mess of a chart. That's the way I'm going to describe it. In the gold miners, we come back to yesterday, you got oversold, you hit the lower Bollinger Band here. Every time you're going to hit a Bollinger Band, I'm going to say that's where I think the pros take money off the table. And yes, you can slide through it. You play the hero for that. Now if it rallies, first resistance, the 100-day average, then the 18. And that's all you did, and I am not in the camp that this is magically suddenly a great market. I still see a downtrend that I think the pros are selling into. We'll see if I'm right or wrong on that. In TLT, it's a runaway to the upside. As much as the market tries to turn, and it's tried, the momentum, it's trying. It just keeps getting more bull news, be it world stock markets falling, being interest rate cuts from central bankers. Let it peak. Don't be a hero in this market. Today you had what's called an outside day up. If today's low is taken out on Wednesday or Thursday, I will look for price in the 18-day average to make a run at each other. Barring that, I never say buy over a Bollinger Band, but I do say when you're embedded, the pros are still buying that market. As for the euro, how do you play this? I still think this market's going to have trouble right here at the combination of the 100, the Bollinger Band, and the 200-day moving average. We'll see if I'm right or wrong. But this is what you call a magical run. That's a 3% run. It's a big run in that market. We'll see if it's able to hold on to it. Next in the oil and gas exploration, SPDR. Lower highs, lower lows. You have an embedded reading. I'm still in the bear camp. I look for support at the lower Bollinger Band and pros to keep selling until they lose the embedded reading. Now, I can understand some traders may want to back away from the energy until they see what OPEC does. I can't blame them. You know, I'm putting out my Spider ETF video, and I put it out between 3:30 and 4. That's not this one. That is the one where I'm saying buy here, sell there. That's what I want you to do. If you haven't tried it, it's time you do so. Go to our website, www.iraepstein.com, under free offerings, sign up for it. Very shortly, we'll keep free for the people that haven't tried it. It'll go into the subscription basis. We're working at the very end of that. And then there's always more products that I offer within it. So we'll see what I come up with. In the meantime, thank you for watching. I'm Ira. I'll see you tomorrow.